Hi everyone, very good evening and welcome back to Grade B. So in today's session, we will be discussing about the prudential directions that has been provided for banking units which are operating in the IFSC gift city. So these particular norms, these are easy to understand, right? And these have been whatever you have studied in your different regulatory examination. If you are someone that who was already preparing for RBI like examinations, so you will not be finding any particular difficulty in preparing for these particular terms and terminologies, right? So with that, let's start. So prudential norms means there are some situations, there are some conditions which are provided that please be careful in these particular aspects, right? So whenever I say prudential norms means these are the directions from the authority to the units that they should be a little bit careful while operating for their businesses. Okay, so the various principles, first of all, these principles are given in the summary format and then they are given in the detailed format. So we'll go through them one by one. Capital adequacy. See, there are Basel norms on capital adequacy, that how much capital you should keep into your banking unit, so that, see, I am not bringing the RBI guidelines onto this capital adequacy etc. over here, because we are reading about the IFSCA. So I just want to keep it plain and simple. Therefore, I am not bringing out any particular RBI guidelines or RBI measures that has been told by RBI over here, because I do not want to create the confusion. Later, I do not want that someone would come up to me and say that, ma'am, you told this particular thing to us. So I am going to strictly abide by what has been given in the IFSCA. Okay, and you guys should also abide by this. So number one is the capital adequacy. Capital adequacy says that whatever business you are doing, a banking business is a risky business. So you should maintain a adequate amount of capital. Now what is the capital? So capital in the banking sector, they are of two types, tier 1, tier 2. Fine, we'll get to know about them in a bit of time, because that capital adequacy is covered in detail, so we will cover that. Number one principle is the capital adequacy, that you should be having adequate capital. Number two is the credit risk and problem assets. Credit risk and problem assets, you are doing the business of banking, you are giving loans to the customer, right? Now customer might pay you back or not pay you back, there is a risk. So that is called as the credit risk and problem assets. Such kind of assets, such kind of loans which you have given to the customer, and now there is the problem of collectability on those particular loans, they are called as the problem assets. We also have another name for this called as the NPA. Fine, I hope you all guys know the full form of NPA. Next is an IBU, that means a banking unit, they should have a adequate credit risk management policy. Apart from that, they must also have the adequate policy for the early identification of the problem assets. Next is transactions with related party. Now what are these early identification of problem assets? See, suppose I am a bank. Okay, I am a bank and there is a customer to whom I have provided a loan. Now if that customer starts defaulting on the EMIs, right? If that particular customer starts defaulting on EMIs, although he pays it but with the 5, 6, 7 days gap, right? So these are the early signs of problem. These are the early signs of problem which are arising, and you should keep a tab on to it. Next is concentration transactions with related parties. So related parties are with which you are having an interest, right? So for businesses also there are related parties. If business is having a ownership interest in another party, or business is having a management related control in the other party, so the such kind of organizations, they come under the radar of related party. So any entity with whom you are related, you have to ensure that the transactions you are entering in, they should be on arm length basis. Arm length basis means there should be no element of favor given to such parties. That means, suppose arm length means the transaction price, the transaction details, the transaction content should be same as it would have been between two unrelated parties. Getting my point? So the transaction should be similar, like if you would have transacted with an unrelated party, similar manner with the related parties as well. Okay, next is concentration risk. Now concentration risk arises when you give loan to a single person or entity or sector. Suppose you have given maximum amount of your loan in the coal sector. Now you know that coal sector is not having a great viable future because of the climate change, as well as along with the coming up of renewable energies. We all know about it, right? So with that particular regard, you should understand this particular thing, that in no one sector, not to one single individual and not to one single entity, your risk should not be concentrated. You should always diversify your risk. So the point is that instead of giving a 10 lakh rupee loan to one individual, you should give the 10 lakh rupee loans to 2-3 individuals. Now in this case, your risk got diversified instead of being concentrated. एक जगह इकट्ठा नहीं हुआ आपका risk. I hope you have understood. Next is the market risk. Market risk means there are operational risks and then there are market risk. Why operational risk arises? These arises because of your own internal policies. Suppose your employees have done any kind of fraud, right? Your directors have done any kinds of activity which they should not have done. So they all come under the operational related risk. Risks which are attached to or with your operating of the business. And next is market risk. Market risk arises because of the competitors, right? So for example, policy change by the government. Government has changed policies. There are competitors. Fine. Inflation, right? State of economy. These are all called as the market risk because they do not arise from your operations, but they do arise from your market. That means the outside environment. Great. Now next is interest rate related risk. You all guys understand it. Next is the liquidity related risk. See, liquidity ratio we have done so many times. Liquidity related things also we have done many times, but I'll tell you. See, liquidity ratio, this is a concept that has been brought by the Basel Committee. If you are a student of regulatory body exams, you must be aware about this particular committee, right? So they have prescribed liquidity ratio. They have said that please understand, whatever are your near-term liabilities. Near-term liability means within 30 days, whatever your liabilities might arise, you should have enough liquid funds to cover that. Liquid fund means those assets, those funds which can be converted into cash within no moment of time. So we have understood when we read accounting, at that particular point also we have understood the difference between the current assets and liquid assets. So again I am repeating my point. Liquidity ratio says that you should have enough liquid funds, highly liquid funds, in order to cover your next 30 days liabilities. Next 30 days, whatever liabilities that might arise onto you, are you able to cover that? That is called as liquidity ratio. So the banking unit, they must have policies that enable the firm to comply with those requirements and to manage the liquidity risk prudently, right? They shall maintain on standalone basis. Number one is the liquidity coverage ratio at a level that is higher of A and B below. Now what is the liquidity ratio that they have to maintain? Minimum LCR prescribed by the home regulator. See, if you are a foreign bank, and you have incorporated in a foreign land, then you have to comply with the regulations that has been prescribed by your home regulator. So whatever has been the minimum LCR prescribed by your home regulator, you have to comply with that, or the minimum LCR prescribed by the authority. Authority means IFSCA. Fine, whichever is higher. In both of them, what is the liquidity ratio prescribed by your home regulator, and what is the liquidity ratio that has been prescribed by our IFSCA IFSC authority, right? Whichever is higher, that is the liquidity ratio you have to maintain. Now the minimum LCR as prescribed by the authority is 100% with effect from April 1, 2021. 100% means whatever liabilities that might arise you for the within next 30 days, you have to give for that. Means you have to have enough liquid funds in order to cover those particular liabilities. Now the second ratio is net stable funding ratio. This is again being prescribed by your Basel committee, right? Net stable funding ratio, we will come on to that. There is a formula of this. I'll tell you. The crux of this particular ratio is that suppose I say I have 1 lakh rupees. I say that I have 1 lakh rupees worth of fund. Okay, right? This is available with me. But right now I require 2 lakh rupees. This is my requirement. This is my requirement of fund and this is my availability of fund, right? So net stable funding ratio, it wants to calculate that what is your requirement and what is the fund that you are having. Available funding divided by the required funding. Now one more thing gets added to in this particular formula, that is called as stability. Fine. So when I am saying that I have 1 lakh rupees, this 1 lakh rupees should be there with me for a longer period of time. It should not happen that just another day someone is coming to me, tomorrow someone is coming to me and they are saying that give me my 50,000 rupees. So we do not want short-term funding. We want to know that how much long-term stable funding you have proportionate to what is the long-term funding required by your banking business. I hope now you understand the NSFR ratio, net stability funding ratio. So what net stability funding ratio you have to maintain? Whatever has been prescribed by the home regulator, and the minimum NSFR as and when prescribed by the authority. Right now, authority has not implemented this particular requirement. And next is the group risk. So group risk is, suppose there is a company, will not take any particular brand's name, so I'll take XYZ Limited, right? This is the company. This company has started a project. For this project, XYZ Limited needs funding, right? Obviously, for any particular project, they need funding in order to complete that particular project. So what they did is, they took loan from various banking units. They took loan from, let's say, ICICI. They also took from HDFC as well as Axis. So now all these banks, they have formed part of a group and they have given the loan to one particular entity, right? So now they are in the group risk. A banking unit and its banking company must effectively manage the risk which are arising from its membership in a group. Now next is the prudential reporting, disclosures and supervision related norms. So we will cover this quickly, right? Because there are only very few points that you need to remember. Apart from that, everything is of a general understanding. So prudential reporting requirements are: see, what is the information that you have to provide to the authority? If you are a banking unit which are operating in the IFSC IFSCA, then these are the information that you have to provide to the authority. Detail about the entity, your group structure. Apart from that, flow of management information, who controls the activities of the group, and any other information about the group that authority may require. Now next is, obviously when these informations are required, you have to file such informations in form of returns, right? So the banking unit, they shall prepare and submit its prudential returns as per the directions of authority. Now, authority may by written notice can require that banking unit should prepare additional returns. They can also exempt the banking unit from preparing any particular return, and they can also extend the period. Now, this is important for us. Prudential return must be signed by the two individuals who are approved for the IBU and assigned for the controlled functions of the IBU. So any two individuals who have been authorized by the banking unit to perform their functions, they will be signing this particular prudential return. What is the information that you need to provide in prudential return? We have already seen what is the structure of your entity, right? In what kind of group you are forming the part of, right? Who's controlling your business organizations, how the information flow is flowing out, every kind of things you have to tell. Next is the regulations regarding the accounting standards and the financial year. So the banking unit, they shall follow the International Financial Reporting Standards, IFRS. Those have been issued by the International Accounting Standards Board. Now understand, in India we have Ind AS, right? Earlier we were having just accounting standards, and after that we brought Ind AS. Now these Ind AS have been brought in order to prepare our Indian accounts in a similar like situation like IFRS. So IFRS, these are applicable internationally. Ind AS are applicable on the entities which are working in India. Fine. So there are turnover requirements. Accordingly, you have the Ind AS will be applicable onto you. Number one thing. Number two thing is, so you can compare the Ind AS with IFRS. IFRS is the internationally applicable accounting standards. Okay? So you have to follow these. IFSCA may permit a banking unit to follow a system of accounting standard other than IFRS also, right? If a banking unit requests for that. Financial year, for the purpose of preparation of financial your statements, they will be taken from April 1 to March 31st. IFSCA may permit to follow a different financial year as well if it is requested. Fine. Next is obligations to notify the authority, not very important, but you can just have a look. Just wait for a second. I'm just going out of the screen. You can pause and you can just read for a second, right? Okay. So these are the things that you have to notify. Any breach or potential breach by the banking company in the respect of the minimum capital requirements for IBU. Any concern about solvency, etc. See, if as a banking unit you are thinking that there are serious problems into your finances, then you should notify the authority regarding that. Any other significant or adverse changes in its capital, they should also be notified to the authority. Internal capital adequacy assessment process. See, obviously you onto you there is a requirement of capital adequacy that has been imposed, but apart from that as well, there is internal assessment that you should be doing as a banking unit, right? You should be doing the internal assessment onto your own, so that because it is required to know that how much adequate your capital is. So such kind of things you have to tell to the authority. Public disclosure requirements, then IBU shall follow the detailed public disclosure requirements as provided under the Basel framework, that is applicable onto the banking company. They should also maintain the written disclosure policy. They must take all reasonable assurance for the accurate and timeliness of the disclosure. What they are meaning, see, whatever you are doing as a banking unit, you have to make certain disclosure. Disclosures means what? Providing information about the operations of your entity. So we make various kinds of financial disclosures in the financial statement. So this is what being said, that whatever norms has been given by the Basel committee, you have to comply with all such norms. Do we have to go into that much detail? No, we don't. We just have to understand that yes, an entity has to give all such disclosures which are mandated by the Basel committee. Next is supervision of prudential requirements. So authority is going to adopt a risk-based supervisory approach. The general expectations of the authority shall include that the convergence of the supervisory regime in the home jurisdiction with the Basel framework, degree and quality of cooperation and coordination with the home regulation. So here it has been said that yes, authority has to maintain a supervision, but such supervision will always be maintained in coordination with the regulations of home regulator. So you see what an authority is performing the role. Authority has to see that what are the requirements of Basel Committee Basel Committee, right? Whatever the requirements they have provided plus the requirements of home regulator. Home regulator means if the bank is a foreign bank, then you have to see that what are the regulations of home regulator, supervision related requirements, and then IFSCA's own supervision related requirements. So if the authority has to do a combined role for that. Now coming up to the capital adequacy. So these directions, they aim to establish that a banking unit must adhere to the capital adequacy requirements. A banking company's total regulatory capital is the sum of tier 1 and tier 2. Now this is what I was telling you. Now tier 1 capital is what? So tier 1 capital, it is the main capital, right? That means your share capital plus your disclosed reserves. Fine. They are your disclosed reserves which you have disclosed in your financial statement. See, as a banking unit, whatever reserves you might be having, some part of it you might be showing in the financial statements and some part of reserves are hidden reserves, right? That you do not disclose in the financial statements, that form part of your tier 2 capital. Tier 2 is the supplementary capital which acts as a buffer. So suppose if a banking unit faces too much losses, so obviously first tier 1 capital will be utilized, and then if anything remains, then it will come to tier 2 capital. What are the inclusions in tier 2 capital? So your undisclosed reserves, hybrid kind of instruments. So there are different kinds of instruments which are issued, which are having, suppose, the features of debt. They can be convertible into the equity later on, like that, right? So such kind of things, they all form part of your tier 2 capital. So I am not what you can say detailing it over here much more. Wait for a second. Yes. So hybrid instruments like your convertible preference shares, convertible debts, like that, they are also included. Apart from that, one more reserve, revaluation reserve, is also included over here. Fine. Revaluation reserve. So see, suppose I had a building and that building today is having a worth of 50 lakh rupees. Tomorrow it is valued at 65 lakh rupees, right? So the difference of 15 lakhs, I have not realized it. Although the value of my building has gone up, but I have not realized this 15 lakh in cash. Understanding my point? So because of that, these revaluation reserves are formed, and because these are not realized in cash, hence I'm not keeping it into the tier 1, but I have kept in the tier 2. Okay. Now the capital should support, wait for a second. The capital should support the banking unit's operations by providing a buffer to absorb losses from its activities. And banking regulations provide that as part of the prudential requirements, the banking unit shall comply with the direction and instructions which are given by the home regulator unless otherwise specified by the IFSCA. So we all know about it. Now these are, they see, I have already told you that in this document very few important topics are there, very few important points are there. So number 1 point is like that also. Banking company, they shall maintain the minimum regulatory capital operations of the IBU. Minimum base capital should be the US dollar 20 million. Now please do not confuse it with the RBI guidelines. We have to follow this. what has been given by the IFSCA. Now, a minimum leverage ratio as defined under the Basel framework for an IBO shall be maintained by its banking company. We'll be coming on to the leverage topic as well. Please wait for a second. Next is the banking unit. They shall furnish a quarterly certificate issued by the authorized officials about compliance regarding the capital adequacy and leverage ratio. So quarterly certificate needs to be issued and it should be submitted within the 45 days after the end of the quarter. Next is the credit related risk. You already understand what does a credit related risk is all about. Fine. So you have to manage your credit risk efficiently. That has been instructed over here. Now, what kind of risks can be covered over here? See. So, under your credit risk related concept, the risk covered includes on balance sheet, off balance sheet, both the kinds of risk. On balance sheet, off balance sheet means what? See, if you have ever read the budget, you must also be aware about it. On balance sheet means the things, the risks that you show in your balance sheet. And there are so many hidden liabilities, hidden risks that you do not show upfront in the balance sheet, that are called as the off balance sheet items. So you have to talk about both kinds of risks over here, including those emanating from financial statements like loans, trade finance you must have provided, interest rates, foreign exchange, credit derivatives. See, as a banking unit, you might be dealing into all such kind of financial products. So as many financial products, as much credit risk will be there. Fine. Next is the general requirements. A banking unit shall implement and maintain a credit risk management policy. Credit risk management policy must be documented and approved by the governing body. Fine. Banking units credit risk management policy should ensure that credit decisions are free from conflict of interest. That means you should not provide the credit, you should not provide the loan, and you should not assume any kind of financial risk because of your related parties. Because suppose I am a director in a banking unit and I might be having an interest in the company, so I cannot provide the loan to that particular company. I have to disclose my interest, whatever it might be. Okay. Next is the credit risk management policy must include. Now, what should be the constituents of your credit risk management policy? Administration of credit risk bearing portfolios, information and analytical techniques to measure the credit, what is the risk that is attached with the credit, analyzing the borrower's ability, whether he will be able to repay the debt that he has taken or not. Fine. There should be well defined criteria for approving credit. So if you are giving loan to any particular person, you have to identify that, okay, monthly income should be this, right? What you can say, civil score be this, civil score should be above 800. So there are criteria that you decide that we will be providing loan to such kind of customers only. So your credit risk management policy says that you should be having a well defined criteria for giving the credit. Next is the process for identifying approving authority for credit given its size and complexity. So who is the authority who will approve for giving the credit, that should also be pre-decided. Now, elements like that, processes to define and identify, measure and assess the credit risk and problem assets, how you are going to identify any particular problem assets, how to track exceptions to the credit limit. Suppose I have provided the 5 lakh rupees overdraft limit to a particular customer. So I have to see that if he has exceeded, then what steps should I take as a banking unit. All such things should be pre-decided only. Now next is your credit risk assessment process. See, obviously where we call the external credit rating agencies as part of credit assessment process. They do our credit assessment, that how much credit risk we are having. Okay. What they do, they take a stress test at least on annual basis, and on that basis they give us the ratings. Now this has been said that as a banking unit you should not solely rely on the ratings given by the external credit rating agencies, but you should also do your own credit assessments, right? You shall establish a defined criteria that how you are going to identify the problem assets, right, and how you are going to deal with it. So this is what has been given over here. Any evergreening exercise should not result. Evergreening exercise, what happens is, suppose I am a customer of a bank, I am not able to repay the loan, fine. So now I should have been classified as a NPA, non-performing asset, right? But the banking people, what they do is they do not want to show that their bank is performing bad. So what they do, they tell me that okay, your EMI is 80,000, we will reschedule it and now you will just have to pay 40,000. So this is called as the evergreening, right? They will not show me as an NPA, they will restructure my loan requirements. So this is wrong. Because there is a stress, you should identify this, and these are the problems of the higher percentages of NPA in our banking system. Also, you should comply with the provisioning norms. So the banks, they classify assets into different criteria, like standard asset, which is not having any problem, substandard asset, right, as well as loss assets, like that criterias are there. So provisions are also decided as per the criteria. What kind of asset it has been, right? Has there been any problem of non-payment, right? So if there is a problem, then you should take the provision. You should keep some amount separate. So all such requirements has to be complied by you. Next is the market risk. So these directions, they tell us the requirements to manage the market risk completely. Now market risk means the risks that emanates from the market prices. Now like default risk, interest rate, credit spread, equity related, foreign exchange, commodity risks, etc. So for the purpose of these directions, a trading book consists of positions in financial instruments. The banking book consists of the assets that are expected to be held to maturity, usually consist of customer loans and deposits of retail and corporate customers. See, what we are talking about is any kind of risk that is emanating from the market. Suppose I have invested in few of the instruments. Now the pricing or prices of the instrument might change. As a bank, I have invested into some shares. Now the pricing of that shares might change because of the market movement. I have not done anything, but the market has shifted. Fine. So interest rates can also vary because of the market. Foreign exchanges, they can also go up and down because of the market. So such kind of things, such kind of risks are there. Now what are the requirements onto that? You should identify your risk. Apart from that, your market risk management policy, you have to make a market risk management policy, and what are the contents of that particular management policy. So what is your investment or trading strategy, you have to give that. After that, you have to provide that what all are the risk factors that can arise. What is the volume and complexity of your activity? What has been your historical performance? And what is the total risk that you are ready to take? Fine. So these are all the things that you have to tell. Next is procedures for how you are going to invest in new products, how you are going to do the exception reporting. Exception reporting means when something goes wrong. If everything is going usual. See, suppose I am managing a factory, right? In that particular factory, everything is going as usual. I do not have to. So in that particular factory, if everything is going normal, everything is going fine, production is going on without any particular problem, so I will not do any kind of reporting. But suppose if a machine breaks down, now this is an exception and I have to report to my high authorities. So in a similar situation, suppose as a banking unit, I am doing the trading. In trading, if everything is going the normal, loss is also within the acceptable limits, right? So no problem. But if you incur a loss beyond a certain percentage, then you have to report, and that is called as exception reporting. Okay, so such kind of things, not very important, you can just have a look once and you will be done. Next is liquidity related risk. Liquidity related risk means the risk of failing to meet the financial obligation in the short term. So this is what liquidity risk is all about. Yes, so last video got interrupted. Now see over here. So we were reading about the liquidity related risk, liquidity risk management. Now what you have to do is, for your liquidity risk management, you have to devise a framework, right? That how you are going to manage your liquidity related risk. You should have a portfolio of high quality liquid assets, means such assets which can be converted into cash readily. After that, you should have robust funding structure. Robust funding structure means which is long term, which is stable, and which is reliable, right? This is not going to flee in some time. Now next is to limit maturity mismatches between the assets and liabilities, a part of asset liability management policy. See, your assets, if they are long term, then they should be financed by long term liability. If the assets are short term, then they should be financed by the short term liabilities. So this is called as the match. Now if you are financing a long term assets with short term liabilities, now this is called as the asset and liability mismatch. Okay. So example, I'll just give you example in easier terms. Suppose if you are giving a loan of 100 rupees, fine, and this loan has been provided for 5 years, and you have taken deposits of 100 rupees from customers, and this is just for 1 year. So this is a mismatch, right? Your asset will be returned in 5 years, and you have to pay back the amount to your persons in just 1 year, right? Next is the responsibility of governing body as well as the senior management. So they have to obtain and review the regular report on liquidity, because they are the ultimate responsible persons for the liquidity related risk. Now the IBO senior management, they shall lay out a liquidity risk management process covering the structure, etc. You should also look for your internal control, how well organized your internal control structure is. After that, liquidity ratio, we have already talked about it. The minimum LCR that has been prescribed by the authority is 100%. Liquidity coverage ratio, what you have to maintain, what has been told by the home regulator or what has been given by the authority, whichever is higher. Fine. Liquidity coverage ratio means you should have enough liquid assets to cover the 30 days net 30 days liabilities. That is called as liquidity ratio. Net stable funding ratio means, net stable funding means the ratio is available stable funding. Stable funding means long term funding. Liquidity ratio is looking at the short term aspect. NSFR looks at the long term aspect. So available stable funding divided by the required stable funding. What is required and what is available with you? This is what needs to be calculated through NSFR. Fine. So already have seen that authority has not prescribed anything for it yet. The definitions, eligibility, etc., they will be provided by the authority. Next is the liquidity management strategy, how you should be managing your risk. So you should have the specific policies on the composition of as well as maturity of asset and liability, whether the liability is for long term in nature or short term in nature, whether the assets are long term in nature or short term in nature. Like that, you should have your liquidity in different currencies. This is called as diversification. You should not keep all eggs in one pot, right? If one egg will break, then all other eggs will also break because of any mishappening. So you should keep all your eggs in different pots. This is what is being set. That means you should always diversify your risk. Next is, what is the process of liquidity risk management? So the banking unit, they should have a sound process for identifying liquidity related risk. They should also set a limit that how much liquidity related risk you can assume. After that, actively manage the collaterals, etc. The collaterals which you have got on the loans, they should be managed, right? You should review them again and again. What is their valuation? If there are any early warning indicators, you should not agree. You should not, what you can say, you should not remove your attention from there. You should focus on to that. Suppose if a customer is not able to pay, or if an asset that you have is losing its value. Suppose you have invested into short term investments, but those are losing its value. So this is an early warning indicator. Okay, when you are dealing into multiple currencies, you should must assess that what is the aggregate currency wise liquidity need. See, when you are trading in different currencies, you need the amount of different currencies to manage your trades. Fine. So you should assess currency wise liquidity related need. Currency shall be treated as a significant for an IBU, right? If the ratio of its liability denominated in such currency to the total liability is more than a level. So suppose minimum level specified by the home regulator, or 10% or any other minimum level authorized by the authority. See what they are saying, if you are most of the times trading or doing the transaction in one currency, that means out of your total liabilities, 10% or more liability is that in that particular currency. So you should give the specific focus on that currency. आपको उस currency पे ज़्यादा focus देना चाहिए, because maximum transactions आप उसी currency में कर रहे हैं. Next is the funding strategy. Funding, from where you are going to receive the funds. See, preparing and documenting a 3-yearly funding strategy you should have, that in next 3 years from where the funds are going to come to you. You should have active presence in the funding markets, right? You should use your capacity to raise the funds quickly. All such things you have to tell in the policy, in your funding related policy, whether you are able to do that or not. The funding strategy, they must be reviewed periodically, at least annually. Fine. If you have said that we will be able to raise funds from these particular sources, whether you have been able to, what are the deviations, right? How much you were not able to take out as a funding, all such things should be disclosed. Next, this is not important, so you can just have a read and just can skip it. Operational risk, I have already told you. Operational risk arises out of the legal risk, but excludes the strategic and reputational related risk. Operational risk, because you are into the business of banking, you should look into such kind of things. What are these things? Yes. So you should have an operational risk management policy that must be documented. It should set out that how bank is identifying the operational related risk. They should also include an approval process for new products. Who's going to approve the new products as well as activities? What are the processes that you are going to adopt in order to identify any kind of operational risk? See, operational risk could be anything that can arise while you are working as a bank. Okay. So one form I have already told you, the fraud done by the employees. If you have followed any particular process wrongly, if you have misjudged any amount, right, the wrong entries, all of that is included in the operational risk. So IBU must immediately notify of the authority if there is any material operational risk event. So such kind of things should be given. Now, business continuity outsourcing policies. Obviously, as a banking unit, you might not be doing everything on your own. So you might be having some of your activities done by someone else. So there are risks arises because of such outsourcing, and you should report about such risks as well. Fine. So your service provider, suppose you have appointed some persons, some other third party agency to do the data level entries in your bank, right? So any risk which might arise due to such activity, you should also list. Now next are some list of certificates as in returns that the banking unit has to prepare. So I have just included them. You can have a read out of them, and they are not very important, not at all important, but still I have included them because they were there in the report. So with that, so there are two videos on prudential norm, the video number 1, video number 2, because there was a power cut in between. Fine. So with that, we'll wrap up our session on prudential norms. We are done with that. Now tomorrow we will be providing you another recorded session on the fund management, right? Your fund assets, funding related things. We are going to cover that. So thank you so much for joining in for this session.